I've been an active stock picker for almost 20 years now. And after several years of doing it very unsuccessfully, I joined the Motley Fool and my education just exploded from there. And I became far more interested in stock picking than I was prior to that. A single decision at a single customer for any reason essentially blows a hole in the investment thesis for a company. The price of the stock and the performance of the business are 100% linked in the long term.
I just want to give a quick word from our friends and sponsors at Vodafone Business. I used to think of Vodafone Business as only a reliable provider of mobile and broadband needs, but they're really stepping up to help Irish businesses grow and flourish in an increasingly digital world. So they now offer a whole array of digital apps, from productivity tools and security solutions to IT support and even website builders. More recently, Vodafone have launched their VHub digital advisory service. With its new service, Irish businesses of all sizes can get free one-to-one digital support and advice tailored to their business by simply booking a call with one of the VHub digital experts on the Vodafone Business website. Search Vodafone VHub for more information. Brian, welcome back to Stock Club. It's a pleasure to have you. How is all over in the States?
Mike, everything is going great here. Thank you for having me again.
I'm really excited to have you on the show. We had you back about a year and a half ago, maybe. And it was one of our most popular episodes. So I know the listeners like you anyways, which is important because I don't think they like me anymore. So we got to keep them on side. But I love what you've kind of done with your voice and the education around investing and stuff. But I'd like to go back to the very start and talk about that kind of moment that sparked your interest in investing. The first foundation, we'll say.
Sure. So I grew up in a household that was very good with personal finances. My parents both earned incomes. My parents both lived below their means. My parents both were good savers. So I had a really good foundation in my life for good personal finance habits. However, my parents were not good with investing. The idea of taking your savings and growing it over time was not something that they excelled at. They were both big believers in putting your money into checking accounts and savings accounts at banks, but nothing basically more sophisticated than that. My dad did dabble in individual stocks a little bit, but I think he was largely doing the exact same thing that I did at the start, which was buying garbage penny stocks with the hopes of essentially trading them to be higher and not doing any fundamental research on the companies themselves, which, to be fair, was very hard to do as an individual investor in the 1990s. So I had a good personal finance background when I graduated from college and started earning a real income, if you will. In 2004, my dad handed me a copy of a book, the first book I ever read that was specifically about money and wealth creation, and that was called Rich Dad, Poor Dad by Robert Kiyosaki. For whatever reason, I was just naturally hardwired to basically ingest that information and want to devour as much financial content as I could get my hands on. That book introduced several concepts to me that were completely foreign to me at the time, such as anybody can build wealth. In one generation, your house is a liability, not an asset. The rich think differently about money. The rich own businesses, etc. And those concepts truly blew my mind. And they kick-started a love affair that continues to this day with me trying to educate myself about everything related to money, investing, and finance that I can. Now, from there, I did graduate to reading a slew of other books. I looked at investing in real estate. I looked at investing in laundromats. I looked at investing in commodities, and I looked at investing in the stock market. The stock market was the best match I found over time for my personality and income. Real estate is a great asset class, but it takes a lot of money and a lot of education to get going in real estate. With the stock market, even back in the mid 2000s, you could start with just a few $100s and kind of teach yourself as you go. And I also learned that I don't like to manage other people, so the idea of owning real estate and dealing with tenants really turned me off. So I found that the best asset class that matches my personality is the stock market, and I've been sticking with it ever since.
So this is putting you on the spot a small bit, but if you could distill your investment philosophy into a sentence, what would that look like?
Sure. Invest in high quality, high growth, long duration assets and hold them until they're no longer great.
Nice. I like that. It's a long sentence now, but I'll take it. It's all right. So I think your catchphrase or one of your goals or mission statements is to demystify the stock market. What do you think is the most important step in demystifying the stock market for investors, either new or old?
Yeah. I firmly believe that the stock market, specifically the US stock market, is the greatest wealth creation machine ever made. It is a system, it is a marketplace that allows ordinary people with ordinary incomes to generate extraordinary wealth within a single a lifetime. It's truly a miracle when you step back and think about it. However, I would argue that 90 to 95% of the general population they know they've heard of what the stock market is, they've heard of what the Dow Jones is, but they know nothing beyond that point. Even people that have money in the markets through a 401k or an IRA, I don't think that many of them could pass a very simple test asking questions like, what is a stock? What is the New York Stock Exchange? Why do stocks have value? How about this one? Who gets the money when you buy stocks on an exchange? A lot of people think that the money you paid goes to the company itself. So I've made it my mission in my career mission statement is to demystify the stock market. And I do my best to provide simple education that helps people to better understand the greatest wealth creation machine of all time.
That's great. And so you didn't originally study finance, but you went back and did a finance MBA. And the route you've taken is very much from an individual investor's perspective. It's not from a finance type, we'll say. A financial MBA, the likely route to go down is hedge fund or investment banking or whatever else. How did you settle on this kind of educational path, we'll call it?
Yep. So when I was in college, I had no idea what I wanted to do for a living. None. So my parents suggested to me, which I think was good advice, just go with a generalized business degree. Right. That is a generic enough major that you can get your hands in a bunch of different aspects of business, and you can kind of learn what you like from there. So I thought that was a decent enough idea. So I did graduate. When I graduated in 2004, I had a business degree, and my concentration was in healthcare management. That seems very specific. The reason that I chose that as my major is if I said that that was my major, I saved $5,000 per year in tuition. So I was like,
That's fair
okay,
enough.
I guess that's my major.
I
Um,
did, I did
so
something
a lot of
similar.
people that take that major go into healthcare consulting, or they go into like the insurance world. And I certainly tried to get my foot in the door with that when I first graduated, but did not come to be. But I did end up working for a startup medical device company right out of college, which proved to be a fortuitous decision. But when I graduated from college, I still had no idea what I wanted to do, or really no idea what interests me in my career. And it was only after working for a couple years and learning about investing did I discover that I was extremely interested and extremely passionate about investing in the stock market. I had no idea how to turn that into a career, so I was mostly just doing it as a hobby and studying it for fun on the sidelines. About 10 years into my career in the medical device world, the company I was working for changed their policy when they basically said, if you go to get an MBA, we'll essentially pay 100% of the tuition at the time. And I kind of thought, well, I don't really need an MBA, but I can't pass up the opportunity to essentially effectively get it for a few $1,000s out of pocket, considering that my company is going to pay for such a big part of the tuition. So when I went back to get my MBA, I decided to concentrate in the thing that interested me at the time, which was finance. And at that point, I'd been investing in the stock market and studying financial statements for more than 10 years. So it was interesting to see how it's taught academically about investing and reading financial statements versus what I'd learned just on my own.
It's interesting how those small decisions of tuition costs and all the rest can dictate such a big part of your life down the road. It's that branch theory, isn't it?
Yep,
Yeah.
absolutely.
So with your background in healthcare stocks, I know that that's one area of the stock market that has interested you. How do you feel that has, was say, given you an edge over other investors? Because healthcare in particular is an incredibly complex industry. I know some of the largest US companies in particular are healthcare stocks, but it's murky waters for someone who doesn't know well enough, I'd imagine.
Absolutely. Healthcare is, I think something like 17 or 18% of the GDP of the United States, and it's an absolutely massive industry, and it's extremely complex. But there are hundreds of billions, if not, there's probably trillions of dollars at this point that are spent on healthcare every year in the United States. So it's just a massive market. Now, my interest in healthcare or my expertise in healthcare really came as a direct result of the job that I had. As I said, when I graduated from college, I was working for a startup medical device company. And when I joined that company, we were pre FDA approval. So no revenue, no product on the market. We were just in the R&D stage. And soon after I joined, we did get FDA approval. And about a year into my employment, we launched the product to the market. My initial role with them was in marketing department. So I was in charge of making brochures, the website, the user guide, all kinds of labeling and stuff like that related to marketing. But after a year, I switched over to being on the sales team, and that was a wonderful decision from both a career and an education perspective, because I saw firsthand just how complicated the United States healthcare market was, and more importantly, from a investing perspective, just how loyal healthcare providers are to certain products or services, and how difficult it can get them to be to change their habits. So I was in the sales for this company for just about 10 years, and it was my job to go out to healthcare providers and convince them to stop using a device that they'd used for a decade or more and to start using my devices. And I learned firsthand just how high the switching costs
Yeah.
are in the medical device industry. And if you look back at history, the medical device industry it has been historically a pretty good place to put capital. The margins are very high. The spending is essentially recession proof, because nobody's going to not get a medical procedure done just because the economy is doing bad. The switching costs are pretty high, and those factors generally lead to high returns on capital for medical device companies, and in turn, pretty good stock returns. So I'd invested in companies like Dexcom, Intuitive Surgical, and the likes, and those companies have been phenomenal long-term holdings. So when I started to become a writer for the Motley Fool in 2015, naturally they said, "Well, how about you focus on the healthcare industry, since you have some background in it?" So I started studying insurance companies in more detail, hospitals in more detail, and of course medical device companies as well.
Yeah, and it feeds into the Warren Buffett concept of circular competence. You
Mhm.
know, you can legitimately say you have an edge there because of that experience and because of being in the room and seeing those switching costs and the barriers to entry for a smaller company like yourself. And that goes into any investor listening. If you are in your 9 to 5 and you have that advantage, informational advantage or operational advantage or whatever it is, if you work in a cybersecurity company, you know that industry better, and that's where you can really get an edge. And that's what Warren Buffett is saying with that circle of competence theory. So that's great. It's great to hear it in action, I suppose, and how it dictated your investing career. Okay, let's get into investing checklists for our listeners who don't know. What is the Feroldi quality score? And I don't know, that could be a very long answer because I've seen the spreadsheet and it's
Yeah.
extensive.
So I've been an active stock picker for almost 20 years now, and after several years of doing it very unsuccessfully, I joined the Motley Fool, and my education just exploded from there, and I became far more interested in stock picking than I was prior to that. Now, if you join any stock picking service out there, very quickly you start to learn that there are far more ideas for your money, then there are actual good places that you should put your money. And at the time, I felt like I was sipping from like a fire hose. Like the number of recommendations and stocks that I should buy was far higher than my capacity to actually buy them. And what I was trying to do at the time was keep everything in my head, where I was like, oh, I really like this company's gross margin and I like their leadership position, but I like that this company is growing faster and it's profitable, but I like that this company has a founder-led management team, and I'm worried about that this company has customer concentration issues. Finally, I got smart enough to say to myself, maybe I should write this down and actually create a system for myself for picking investments. So I've now done this. I've now iterated on this checklist that you're speaking of multiple times. I'm currently on version 3 of it, and it's more battle tested than it's been in the past. But broadly speaking, I have a set of criteria that best match what I personally am looking for in an investment. And whenever I come across a new stock idea or a new business, I take that company through my investing checklist. And I ask myself things like, what do the financial statements look like, right? I want to see a strong balance sheet, a high gross margin, high returns on capital, free cash flow, earnings, and earnings per share growth. I ask, what's the competitive advantage of this company? What's the moat? Does it have a network effect moat, a switching cost moat, a cost advantage moat, an intangible moat, or counter positioning? And importantly, what's the direction of that moat? I ask myself, what's the long term growth potential of this company? Is it growing organically or via acquisition? Is it a top dog and first mover in its industry? Does it have operating leverage in the business? Does it have some demonstrated signs of optionality? Et cetera, et cetera. So my list is pretty long. Is pretty long. And as I go down and fill it in, I get an idea for how high of a match is this investment for what I personally am looking for. Now, after that's done, I then take it through my anti-checklist, or something that I call the gauntlet, which is basically a list of criteria that turn me off as an investor. So for me, that's things like accounting irregularities. If you have accounting irregularities, you're dead to me. I'm not interested in you, right? If I can't trust the numbers, I'm not going to make an investment in the business. I don't like any customer concentration or any supplier concentration. I don't like single points of failure in businesses. I don't like it when a company is in an industry that's being disrupted. I don't like it when it depends on outside market prices for success, such as interest rates or oil prices. I don't like it when a company has high stock-based compensation, et cetera, et cetera, et cetera. So with my checklist, I can now take any company I've never come across, run it through my checklist in the matter of about an hour or so. And at the end of that process, I get a very clear idea for, is this company a match for what I'm looking for, or is it not? And then I just research further the ones that are best match and wait until I think they're trading at attractive prices and add them to my portfolio.
There you go. Simple as. Out of the out of the metrics you look at, which do you think are most often overlooked by investors from that checklist?
Overlooked by investors? That's a hard one to say. I would say customer concentration is a pretty serious risk in my opinion. Essentially, when one company gets 10% or more of its revenue from a single source, that's a big risk to me as an investor. And I've gotten burned in the past by buying companies that get 50% of their revenue from companies like Walmart or from Apple, and that means that a single decision at a single customer for any reason essentially blows a hole in the investment thesis for a company. Another one that I think is overlooked is what's called optionality. It's just does the company have the ability or a demonstrated history of rolling out new products or new services that open up needle moving revenue opportunities. When I look back at the biggest winners of all time that I have, that's companies like Mercado Libre, Amazon, and Tesla. And all three of those companies, when I bought them, now look completely different from a revenue perspective than they did when I initially bought them, because they were internally developing products and services that opened up brand new revenue opportunities down the road. I mean, the classic example is AWS at Amazon, right? When I bought Amazon, it was a leading e-commerce retailer, and things like Amazon Prime and AWS didn't really exist at all. But those have now become major contributors to both the company's top and bottom line. And more recently, advertising, which wasn't even on my radar at all when I was an initial investor in Amazon, is now becoming a significant source of high margin recurring revenue for Amazon. With Tesla, when I bought Tesla, the only product it had was the Model S. And now it has 4 models that are on the road and many more models to come. Tesla probably has the highest optionality of any company I've ever studied as an investor. And Mercado Libre, when I bought it, was just like the eBay of Latin America. And it was just starting to get into the payments business. You can make a strong argument now that Mercado Libre is more of a payments company than it is an e-commerce a company. So I think that trying to find investments that have strong optionality, the ability to launch new products and new services internally that generate needle moving, that one's key, needle moving growth is a really underlooked way to invest.
That's great, yeah. And 3 very subtle humble brags there of showing you when you invested in those 3 businesses.
Mhm.
Okay, so I want to talk about AI. Have you ever thought about coding that checklist into some sort of Brian bot that almost does it for you?
I have not.
No?
But the AI tools that are out there are getting easier all the time. So I guess that's something that could be done in the future, but that's well outside my area of expertise.
Yeah, you're happy to get down in the nitty gritty for now.
Absolutely. Are you talking about essentially encoding something that goes out to the financial statements or goes out to the annual report and actually like pulls the data in a more systematized way?
Yeah, exactly. You can just feed it a ticker and it'll spit out your Feroldi score at the bottom.
Yeah, I don't know if that would be possible because a lot of the things on my scoring system are subjective by the very nature. I don't think any AI would be able to tell you, "Oh, this company has a great network effect working for it," or "This company is counter positioning in its industry." Some of these things could certainly be automated. For example, I like to check: does the company have a history of exceeding Wall Street's estimates? Does the company have a history of outperforming the S&P 500? What is the company's Glassdoor rating? So some things on my checklist could certainly be automated, but I actually find there's a lot of value of doing it manually because it takes time to really develop a thesis and, importantly, believe that thesis on the inside and to have conviction in a company. I don't think I could do that by simply reading an AI generated report. I would still personally want to do the work manually myself. But using AI as an initial extra screening tool before I would take the time to do it on a company, that makes sense to me.
Yeah, that's interesting how you said that, how you wouldn't maybe be able to trust that the AI is right, because it reminds me of Jim Simons from Renaissance Technology. So he's one of the early leaders in quant investing. And I remember he used the models were making money, but he wasn't sure why, and he couldn't sit right with it. And he's making hundreds of millions, but he would stop it and make sure he could figure out exactly why the money was being made, and then he could eventually trust it. So it's interesting where you're talking about there is definitely a place for AI when it comes to analysis and everything, but the human touch is certainly needed, I think, and I would agree with you there too.
Yep. Well, let's say you did develop an AI system, and the AI said this stock is a great long term buy, and you go out and buy that stock, and then that stock falls 30%. What do
Yeah,
you do then? Right? If you don't have the conviction to know what is going on and is the long term thesis in this company busted, you're going to be in a place where you have no clue what to do next. And the odds of you panic selling out of that investment, I would think, would skyrocket at that point. At least they certainly would for me. So taking the time up front to know why you're investing, what could go wrong, and really developing a process to yourself, that seems like a lot of work, but it pays dividends for years to come.
yeah, you can't borrow conviction, isn't that the
Right.
saying? Okay, we're going to do a bit of a quick fire round. So I'm just going to throw a few questions at you. You can just give me a 1 sentence answer or a fast answer. We'll call it that. All right.
Sure.
Okay. So first off, your best investment decision:
Buying Tesla,
buying Tesla. Do you want to give a year just to give a proper brag?
2012,
Very
2012.
nice. Okay. Your worst investment decision.
Geez, how much time do you have? Using leverage, using a synthetic long to buy Kinder Morgan.
Okay, very good. Most important metric in your checklist.
Boy, that's a hard one. Moat.
Moat, nice. Uh, on moats, then, which moat would you think is the most profitable? We'll call it for an investment.
Network effect.
Network effect, very nice. Okay, your biggest missed opportunity. If you could go back in time and push the buy button or the sell button.
Dexcom. I owned a company called Dexcom, a medical device company, for about 6 weeks, and that turned out to be, and then it 50 bagged since then. So
Yeah.
I had a firsthand understanding of how good that company was doing, how fast it was growing, everything. That should have been a top holding for me, and I should have hundreds of thousands, if not millions of dollars in that company by now, if I knew what I was doing.
I think I would know to the red cent how much I would have had if that was me. Are you actually, speaking of Dexcom, are you worried about iPhone? Sorry, not iPhone. What Apple are doing in the space now with the Apple Watch? Do you think
Oh,
that?
potentially.
Yeah.
Yeah,
Uh,
I mean, Apple is always to be, to be considered. But breaking into healthcare is not easy, and I think Dexcom has done a nice job about building itself. It's always been on the leader in from a technology perspective, but to be honest, I have not studied what Apple is doing in the space all that closely.
okay. Your favorite book on investing?
Um, I'll go with Warren Buffett and the Interpretation of Financial Statements.
Very nice. The most common mistake you see investors make?
Selling too early.
Selling too early. Yeah, I think that's almost verbatim. Either the biggest mistake people make themselves or the biggest mistake they see other people make is the early sell. The one thing you wish everyone knew about investing?
That the price of the stock and the performance of the business are 100% linked in the long term.
What makes, this is a tough one now maybe to get into one sentence, but what makes a company anti-fragile? I know this is more
Yeah.
Brian Stoffel's investment thesis, but I love the term
Cash and options.
cash and options. If you can only invest in technology or healthcare stocks from here on out, which would you choose?
Technology.
What non-investing activity do you find to be the most beneficial to your investing career?
Walking.
Walking. Yeah. Keep it simple. And then just to finish up, your favorite writer or financial commentator right now?
Morgan Housel.
Morgan Housel, yeah. Very good. Okay, we're going to finish up. I'm going to ask you, and I know this is very reductive from all you've told and everything, but if you can, because this is what the people tune in for, to give us some of your favorite stocks right now, investing trends, or even areas to avoid. You've carte blanche to go ahead with that one.
Yeah, sure. So in the last 19 years, we've seen I've invested through some interesting market cycles. The thing that the market taught investors during the 2010s was essentially de-emphasize valuation and chase growth at all costs. And in a zero interest rate environment, that investing style worked extremely well. Now, over the last year, with interest rates finally rising, with inflation finally coming back, interest rates have to be considered, and valuation has to be considered now far more than at any time over the last 15 years or so. So I am more focused on valuation today than I have been historically. But see, even with that being said, I personally still like to invest in underlying megatrends and to ride out megatrends for a long period of time. And I still think that e-commerce is a megatrend that is out there that will be the gift that keeps on giving to investors for decades to come. I think you can also make the same case with the fintech. There are a lot of great financial services companies out there and financial technology companies out there. And I think the move towards digital payments is still in the very early innings of its growth cycle. So those two categories have experienced gut-wrenching volatility in both directions over the last 3 years, but I still think both of them are a great place to look for investment ideas.
For established trends like that, would you look for international participants? So Mercado Libre is a great example, but you could go as far as uh, C Limited
Yep.
over in Southeast Asia. I know like TikTok is having a huge influence in the TikTok shop, especially in China. Is seeing a trend that works, we'll say in the US, maybe developing in a fast growing nation. Is that a tactic you would use there?
I think so. Investing in foreign companies does come with its own set of challenges. They don't think of shareholders the same way. They don't have the same shareholder protections that we do in the US. So it is my preference, whenever possible, to buy companies that are listed on US exchanges, because then they have to comply with GAAP accounting and US disclosure standards. But yes, to your point, if a trend works in the United States, it can be a great trend to look for in other countries. My personal preference is to buy companies that are in the US, that are succeeding in the US, that are taking their technologies developed in the US, and the companies themselves are commercializing them internationally. That's my favorite way to play the international markets, is through US based companies. But in some cases, going directly to those companies, such as Mercado Libre, can make sense.
Okay, I'm going to put you on the spot. So, favorite e-commerce stock right now?
Mercado Libre.
Are you going to say the same for fintech?
Oh, for fintech? Oh yeah. Yeah, I mean, it's also a great fintech. It's also a great fintech play. One company that I know is a great business and it's really down on its luck, but I've never studied it closely, is Adyen. So that's on my research list, and I know a lot of investors that I respect have a huge amount of interest in and have bought shares of Adyen. It's not one that I've studied closely, but it's very high up on my research list.
Absolutely. And there's so much attention on it now. I think it was one of those high flyers, and a lot of people saw it as the Europe's version of Stripe, but I think it's down about 50% since its most recent earnings, about 80% from all time highs. So I think people are smelling an opportunity there. But what would you say, especially in terms of fintech, the general discourse is going along the lines of maybe it's becoming commoditized in the payment
Mhm.
space and payment processors? What are your thoughts on that?
That is entirely possible, but I think that there's a lot to payment processors. I mean, when you think about making digital payments securely, fraud free, and doing that very easily is something that I think companies are going. That's a core service that companies are going to need for years to come. Ditto for transferring money to friends and family. So there is an argument made that there's been so much innovation in the space that margins are going to come down, take rates are going to come down. And if that is true, then fintech might not be a great place to have capital long term. But I still personally, Visa and Mastercard are two of my biggest positions personally, and both of those companies I think are well positioned to continue to succeed, no matter kind of what happens with the level below them. But still, even with that in mind, I think the fintech area is a very interesting place for investors to look, and still could have long-term potential.
Okay, I'm going to ask you one last question now, and then I'm going to let you go because I know I've put you on the spot about 5 times already. But we're talking fintech. PayPal, do you think deep value territory, value trap, somewhere in between?
I own PayPal. My hunch is that it's a value opportunity, not a value trap, and my money is where my mouth is on that one. But I will say the market has really, really punished that company. So it's possible that I'm overlooking something.
Okay. Thank you very much, Brian. It's been an absolute pleasure. We will hopefully see you again on Stock Club soon. Take it easy, all right? And actually, if you want to tell people where you're writing, so you have your book, Why Does the Stock Market Go Up, is out on Amazon and all the rest, and then your newsletter, Long Term Mindset. Is there anything else you want to plug while you're here?
Yeah, well, we mentioned my investing checklist before. I do make that freely downloadable if people are interested. So it's just brianferoldi.com/checklist. If you could throw a link in the show notes to that, that would be great.
Perfect. All right. You'll see everything in the show notes. Brian, thank you very much. It's been a pleasure. And thanks everyone for listening. Remember, if you'd like us to talk about any stocks in particular, you can message us on Twitter at MyWallStreetHQ, on TikTok at MyWallStreet, or simply just email us at pod@mywallstreet.com. Thank you very much for tuning in this week, and we will talk to you again. Before we finish up the show, I just want to give a quick word to our friends and sponsors at Vodafone Business. They recently launched their VHub digital advisory service, offering Irish business of all sizes free one-to-one digital support and advice. You don't even have to be a Vodafone Business customer to avail of this service. Just search Vodafone V Hub to book a call with one of their digital experts, and we will leave a link in the show notes for today's episode.